Good morning, all the members. We welcome you today on Sunday morning and out of a very busy schedule, but on a very important topic. We are gathering today on a study circle meeting, JB Nagar CP Study Circle, and we have invited our today's speaker, CA Suhash Malankar sir, who is going to enlighten us on a very important topic, taxation of charitable trusts as per the latest amendments in the Finance Act 2022. Before we start our today's sessions, because of some technical glitches, we are starting little 5-7 minutes late. So please bear with us. Before we go towards the formal introduction of the today's speaker, we'll run our institute motto song as a mark of our respect. We request all the members to please remain in the alert mode while we play our institute motto song.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैत 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 एतद्द्वैत.
Thank you, members. So now we'll request our past convener and a core group member, Sri Chintan Bhai Shah, to take the formal introduction of the today's speaker, CA Suhash Malankar. So over to you, Chintan Bhai.
Thank you, convener sir, for giving this opportunity of introduction of today's learned speaker, CA Suhash Malankar. CA Suhash Malankar is the proprietor of Suhash Malankar and Company, and he passed his CA examination in 1987. He has won many prizes in extracurricular and curricular activities in school, colleges, and at university level. He was also a lecturer in junior college and degree college for 3 years. And for past 34 years, he has been in full-time practice in Mumbai. His major areas of practice is income tax and GST, handling company and non-company audits. He has extensive experience in the matters related to trust, charitable societies, and regarding their audit, registration, and including their income tax matters. He has also obtained FCRA registration from Ministry of Home Affairs for his clients. He was the founder convener of Goregaon West CP Study Circle and also the convener for 3 years from 2005-06 to 8-9. Until date, he's actively associated as coordinator with the study circle. He has been a regular speaker at the seminars organized by WIRC of ICI, its branches and its study circles in Mumbai and other places on the subject of charitable trust and taxation and other laws related to charitable trust. He has also delivered lectures at other locations out of Mumbai. He is a regular contributor to the reference manual published by WIRC of ICI on the topic Maharashtra Public Charitable Trust Act for past several years. And he's also the co-author of the book Charitable and Religious Trust published by WIRC of ICI in the year 2021. With this introduction of the learned speaker, may I request the speaker to please take on the processing ahead.
So thank you, Chintan Bhai. Before Suhash sir can take it further, just from my side, we thank Chintan Bhai as in today's caller, in spite of his bad health, is now here with us to take this opportunity to introduce today's speaker. So thank you, Chintan Bhai, for helping us in having the today's sessions and coordinating with us. And now there are 2-3 announcements. Basically, since we are on a Zoom mode, We request all the members, whatever queries you have, you just can drop it down in your chat box so that as per the time permit, today's speaker can take your queries in best manner as per the permissible time. So now with this, we request our today's speaker, Suhash Malankar sir, to please take its session further.
Yeah. Am I audible?
Yes, sir, you are audible very much.
Okay. Thank you, friends, for inviting me to your study circle. And I think I have been invited for delivering speech at the study circle for the first time, as far as I remember it. And I consider it as an honor because it is one of the biggest study circle, I think, in the Mumbai. And here we go. Friends, as far as the charitable trust taxation is concerned, this is prime area of concern for the department also, it seems, because if you observe over past several years, if I'm not mistaken, right from 2008 or 2009, every budget has made some amendment or the other to the provisions related to taxation of charitable trust. Some are minor, some are major, some are having far-reaching consequences. And if we see in the recent past, if we go 20, the budget 20 introduced a new provision for registration, and we are aware that we have gone through it, and for most of our clients we have obtained registrations. Earlier you were aware that the registrations were permanent, that is under 12A, and ATG registrations were made permanent, that is they were lifetime. Once you have obtained a registration or approval, that was lifetime. Same was the position with 1023C. But now with this amendment made by 20 budget, this period has been curtailed to maximum 5 years period, and they have also introduced concept of provisional registration. Likewise, there were many amendments. There are certain amendments in Finance Act 21, and as usual, there are amendments in Finance Act 22. Now, as far as Finance Act 21, there are few amendments, but as far as Finance Act 22 are concerned, as far as my reading goes, if you see the budget document, there are about 100 pages covering these amendments, considering all notes on clauses, explanatory memorandum, and proposals, budget proposals themselves. So about 100 pages covering or catering to the amendment related to charitable trust. Such a what I can say, major amendments, I can say. Some are having, will have major impact. And as far as 21 is concerned, Finance Act 21 is concerned, they were effective for assessment year 22-23. That is financial year that we are currently, that is recently over, that is March 22. But as far as Finance Act 22 is concerned, they are with respect to three different assessment years. I'll come to it as we go along. Now, first of all, initially, I have to clarify one thing. Whenever I say word trust or institution, one has to understand that trust or institution will include societies registered under 1860 Act, charitable societies or religious societies. Secondly, public trust registered under Maharashtra Public Trust Act. And thirdly, Section 8 companies also, and all other eligible institutions, funds or institutions which are entitled to benefit under Section 11 or 12, or entitled to benefit under Section 1023C. Okay. So this one has to keep in mind. So interchangeably, I will be using word trust or institution throughout the presentation. Secondly, I have a habit of speaking like they, and all that I'm addressing. So pardon me for that. But when I say they, that will generally mean that is income tax department. If I am not very specific, say they have made amendment, means income tax department has made amendments like that. Okay. Now going ahead with the subject proper. First of all, we'll cover. Now there are few amendments. Now conveners requested me to cover amendments with respect to Finance Act 21 also. So here we go. Now, how the presentation you will be moving?
Yes, sir. Yes, sir.
Okay.
So
Okay.
I'm having,
So first part that is amendment made by Finance Act 21 and major amendment to Section 11, corpus donation. The first major amendment relates to corpus donation. Now, most of you must have studied this, and you must have understood it by now. So this is just a recap. You are aware, friends, that as far as the corpus donations were concerned, there were no conditions attached. Only condition that corpus donation prior to this amendment. I am talking about prior to this amendment. And prior to this amendment, there were no condition attached. Only thing was that the donor had to give a letter. There should have been a letter, or there should be a letter from donor saying that it is for the purpose of corpus of the trust, or it is for some purpose like building fund or building construction fund or such capital asset creation fund. There should have been letter from the donor. That was the only condition. But as far as this amendment is concerned, the amendment says that the corpus donation later you have received a corpus donation, that is not sufficient for claiming exemption. What is further required is that amount which is received by way of corpus donation has to be invested specifically, has to be invested in permitted modes. Permitted modes are given in section 11.5. So has to be invested in either, say, there are various modes given by section 11.5. Generally, the scheduled bank, investment in scheduled bank and FDs with scheduled bank is one of the modes. And friends, as far as scheduled banks are concerned, one should not say that if you see second schedule of the RBI Act 1934, it gives a exhaustive list of the scheduled bank. It consists of banks like Citibank, ICICI Bank, private banks, UCBs and State Bank, etc. To begin with, State Bank and its subsidiaries. Now subsidiaries are not there, but State Bank and all nationalized bank, then private sector bank. So it is a whole list of entire banking sector is covered in that much I can say, Wendy. So all the major banks are there. So amount that has to be invested in space. Apart from that, there are several other modes which have been prescribed. So the amount has to be invested in specific earmark investment. And when that has to be done, as far as the section is concerned, it stops with that amendment and it does not say when that amount has to be invested. But as far as we are concerned, since each previous year is a unit for assessment, one has to assume that the amount has to be invested. If the trust receives the amount in a particular financial year or particular previous year, that amount has to be invested in particular manner or particular type of securities or funds before end of the financial year. Supposing, to give an example, supposing 10 lakh rupees is received by way of donation, by corpus donation, and that entire amount has to be invested before end of that particular financial year only. Supposing 10 lakh is received and amount is not invested, that amount will become taxable. That is in nutshell the provision or amendment is. Now, this amendment is one can say a very harsh amendment, but harsh amendment in the sense it requires you to trust to be careful that they have to invest that amount before end of the year. If that amount is not invested before end of the year, then they lose the benefit of exemption benefit. Now, one thing has to be kept in mind as far as corpus donation are concerned. Generally, corpus donation are collected for the purpose of some acquiring some capital asset like land, building, etc. And for that purpose, a substantial amount has to be collected, and that amount cannot be amassed. And that amount cannot be amassed in say 1 or 2 years period of time. It requires a substantial period of time, say 4 years, 5 years or so. So every year, whenever that amount is received by a particular trust, that amount before one has to take care, trust has to take care that amount is invested in particular modes like say FDs or, and they should be, it cannot be kept in current account or saving account. I have been hearing now that some of the banks are not allowing trust to open saving account, but to my mind the saving account to be open. But whatever, whether it is current account or regular account, current account or saving account, So it cannot be kept in that account. It has to be invested in a particular mode, because word use is specifically maintained for such purpose. So it has to be specifically invested, and generally investment in FD would suffice the purpose. Moving ahead, next point, point number 2. Now, here again, one more point I would like to clarify. As far as this provision says, it says that amount has to be invested. Now, when that amount can be drawn and what happens to the taxability of that, nothing has been mentioned in the provision. So, according to me, what happens is, supposing in one particular year, amount is received, and before end of the year, it is invested in FD of the scheduled bank. Okay, compliance of the provision is there. You come out, trust comes out with the taxability net, and corpus donation cannot be taxed. That happens. Now, next year, when the fund wants to, or the trust wants to utilize that amount, when it is utilized from that fixed deposit is broken and the amount is utilized or withdrawn, then at that time taxability, according to me, the taxability cannot be attracted, because provisions are not saying about taxability of the subsequent withdrawal. So according to me, once it is invested, particular amount received is invested before end of the year, that is a sufficient compliance of the provision, and you get a trust becomes entitled to claim the benefit. Moving ahead. Next, point number 2. Yeah.
You want
Yeah.
me to scroll down the presentation, your PDF file?
I can move. You are able to see my screen?
I will be able to move.
Yeah, you can. Or I can move, but I am not able to. No? I'll move, but are you able to see it? You are able to see it?
I can see it, and even I can move it because I have shared the screen. Every time, whenever you want to go to the next point now or next page, you will have to tell me that now you move to the next page or next point.
That you will have to do, or whether I can do it.
I will have to do. I will have to do.
Okay, so you do it. That is why I am telling. I'm on point number 2. I am on point number 2 now. That is amount spent out of corpus donation not to be treated as application. Okay. Okay. Now amount spent out of corpus donation not to be treated as application. This amendment further says that actually it is sort of, one can say it is a clarificatory amendment, and all along we understood the law like that. Whenever corpus donation is received, it has to be spent or it has to be utilized for particular purposes, and it is not to be mixed with regular expenditure, or it should not be utilized for regular application. So this is what it clarifies. This amendment clarifies that amount spent out of corpus donation not to be treated as application for the purpose of section 11(1)(a) and (b). 11(1)(a) and (b) means amount applied out of regular income. So regular income, regular voluntary contribution has to be kept separately, to be treated separately, and regular expense. You are aware that out of the regular income, 85% has to be spent. So the corpus donation should not be mixed with it. That is what this amendment says, and I think this is okay. This is okay. So there is no problem. Moving ahead. Point number 3. You can move presentation. Point number 3 is any amount applied out of loan or borrowing shall not be treated as application. Okay. Now here, as far as this amendment is concerned, now it creates a peculiar situation. Earlier, this was not so. Whenever trust or the organization was taking a loan, then in that case, amount is borrowed, amount is received during that financial year, and amount is utilized for that during that particular year, whether for capital purposes, generally for capital purposes, or even for revenue purposes. The amount is utilized and amount is received during particular year, and amount is applied in the same year. Funds are received in same year and utilized in the same year. So receipt and payment was matching, and it was allowed as application. Now, as far as this amendment is concerned, what has been done is, the trust or the fund receives a loan in this year. Okay. But The amount has to be treated as application is not when the amount is spent for those particular purposes, but the amount has to be treated as application when the loan is repaid. So that means, supposing, for example, a trust has taken a loan of 10 lakh rupees during this financial year. Now, during this financial, out of 10 lakh, let us assume for the sake of simplicity, the loan has to be repaid over a period of 10 years. So every year, the loan, say 1 lakh rupees loan is to be repaid. Now, let us say out of 10 lakh rupees borrowed, the entire 10 lakh rupees has been utilized for the purpose of acquiring some fixed asset. Let us say hospital has utilized for acquiring machinery or equipment. But then that though hospital or that institution has utilized that amount, full amount of loan, in that year, it will not be treated as application. But when the loan is repaid, now when the loan is repaid, so assuming a period of 10 years repayment, say out of 10 lakh, only in first year, only 1 lakh rupees is repaid. So only 1 lakh rupees is to be allowed as application as a repayment whenever repayment is made. This doesn't talk about the interest part. So according to me, the interest as and when paid will be treated as application. That is according to my mind, that should be the position. But as far as the repayment is concerned, only repayment will be treated whenever repayment is made, whether this year or subsequent year or subsequent year. In that year only, the application, it will be treated as application. Next point, point number 4 is excess application of earlier years will not be allowed to be set off against income of subsequent year. Now this amendment has got far reaching consequences, and this has become effective from assessment year 22-23, a major amendment as to that. And earlier what we used to do, or earlier what was allowed prior to this amendment, what was allowed is, supposing a trust or institution has an income of 10 lakh, okay, but they have spent 12 lakh rupees. So 2 lakh rupees extra was spent. That 2 lakh rupees extra was spent, was allowed to be carried forward, was allowed to be set up against future income. Let us say in next year there is a shortfall in spending. Let us say 85% is not spent in next year. So that 2 lakh rupees which were extra spent in earlier year were allowed to be set off in the next year. Actually, there was no proper mechanism of showing that in return of income and all that, but it could have been simply added to the application during the year, and that way it could have been shown. So in simple words, it could have been shown against the future income, but that benefit is lost now. Even whatever carry forward or whatever accumulated losses are there, extra spendings are there, say beyond assessment year 20 to 23, from 20 to 23 you do not get this benefit. So 21-22 was the last year where you could have claimed the setup. So the current financial year, that is financial year ended on 31st March 22, this benefit is not available now. Moving ahead, amendment to section 1023C. As far as section 1023C is concerned, again, as far as amendment made by the Finance Act 21 are concerned, they are universally applicable for assessment year 22-23 only. No confusion there. Not for different assessment year. They are applicable for assessment year 22-23 only. Now here, what has been done is the first out of 1023C. First out of, I'm on page number 2, first point, amendment to section 1023C, limit of aggregate annual receipt raised to rupees 5 crore. Okay, earlier, now this is applicable to 3AD and 3AE, meaning to educational institutions and the university or other educational institutions and hospitals, etc. So here the limit was, earlier the limit was 1 crore for gross receipt. If gross receipts were up to rupees 1 crore, then there was even the benefit of exemption was generally available. Only one condition which was there in 139(4)(c), even the filing of return in such cases was not necessary. Okay, for claiming the benefit. filing of return has been made compulsory for all the most of the sections which are there in this 1023 1023C, most of the sections which has been made compulsory, but as far as approval was not there. So I'm sorry. So only filing of return was sufficient. No other registration or no such requirement or no approval was necessary in this case when the gross receipts were less than 1 crore rupees. This limit has been raised to 5 crore. Now, when we talk about limit of 5 crore, earlier what used to happen, in some court cases or some judgments, it has been held by courts that limit of 1 crore is applicable for a individual educational institution or individual hospital. Let us take a case of a trust is there and they are having 10 educational institutions. They are running 10 educational institutions. Now, for each educational institution, this 1 crore limit was considered. But now this amendment says that this limit 5 crore limit is there. This limit is there for all the educational institutions or hospitals being run under that particular trust. So, friends, the position would be like this. For small trust or small educational institutions which have receipts up to 2 crore or 3 crore, this is a beneficial provision, and only 1 or 2 educational institutions are there. But where there are a big trust are there and their receipts are crossing 5 crore rupees, then for such trust they will lose benefit of this under this particular sub clauses. Moving ahead. Okay. Now, as far as they have been trying, that is income tax department have been trying to bring this provision, that is 1023C benefits and 1112 benefits on parity. This was again an attempt made last year, that investment of corpus donation. So where they made provision amendment as to section 1D, they made amendment that that investment is required to be done. Same in the same manner, they have introduced amendment here. Third provision was amended, and in similar fashion, that amount has to be invested before end of the year. Before end of the year is not said, this is my understanding, but amount has to be invested before end of the year in which the amount corpus donation is received. Moving ahead, point number 3 in 1023C, I am on page number 3. The application out of corpus donation shall not be treated as again similar provision as we have seen, that application out of corpus donation shall not be treated, because corpus donation has to be kept on separate footing, compartmentalized, and regular donations have to be kept on separate footing, compartmentalized. Actually, here it goes further, even in that section 1112 also, 11 also they have made, 11(1)(d) also they have made a similar change. They say, however, when the amount whichever is earlier not treated as application shall be treated as application when such amount is invested or deposited back into one or more forms or more specified in section 11(5). Means they say actually it is a confusing amendment. Actually, okay. So whenever the amount which is not treated as amend and which is not treated as application earlier, when it is invested, that time it has to be treated as application. I think this can amount as a beneficial provision, but practically it is difficult, because say you have to have that amount invested for acquiring a long-term asset. You keep that fund invested for acquiring long-term asset, and you are going to utilize that fund for acquiring long-term asset, and at that time only you are going to withdraw that amount. So I think there is some confusion with respect to this, and what can happen is a corpus donation when subsequently invested can also become entitled to exemption benefit. What comes to my mind, it can so happen with this, it can so happen, supposing 10 lakh rupees corpus donation is received, and say only 8 lakh rupees is invested, and 2 lakh rupees is not invested. There is a shortfall of investment. Then when subsequently that 2 lakh rupees which was not invested earlier then it can be treated as application. If we analyze and understand that provision, this provision from that angle, then this is okay. What I understand. Then any amount spent out of loan or borrowing shall not be treated, same ditto. Any amount spent out of loan borrowing shall not be treated as application. I have discussed this. That's similar to what we saw under section 11. Same thing. When you take the loan, when the trust takes the loan, at that time the trust receives the loan, amount is utilized, but it is not to be treated as application. But when the amount is repaid, in that year, that amount is to be treated as application. And the last point, that is point number 5 in 1023C amendment, that is excess application of earlier year. Same, excess application of earlier year will not be allowed to be set off against income of subsequent years. So in simple word, we have a set off of losses, that is carry forward of excess expenditure and setting off in subsequent year. That benefit is lost now. That benefit is not available from assessment year 22-23. Moving ahead. Now we go to page number 4 of my presentation, and part B. Amendment made by Finance Act 22. Just a moment. Amendment made by Finance Act 22. Now, as far as Finance Act 22 is concerned, as I have said, the amendments are with respect to assessment year 21-22. Amendments are with respect to assessment year 22-23, and amendments are with respect to assessment year 23-24 effectively. So now what is the intention of the department? The intention of the department has been mentioned in explanatory memorandum, which I have a part of it, certain part of it I have printed here, or I have included in my notes, which reads as follows. It says rationalization. Their purpose is rationalization. They say rationalization of the provisions of charitable trust and institution. What they say, the exemption of this trust or institution to this trust or institution is available under two regimes. Regime for any fund or institution referred to in subclauses 4, 5, 6, 6A or 1023C of section 10, referred to as trust or institution under first regime, and regime for the trust register under section 12AA or 12AB, referred to as trust under second regime. So what they, for the purpose of referring to in explanatory memorandum, they have used this wording as trust falling under first regime. First regime means which comes in the order first. Section 1023C comes in the order first, so that is first regime. Section 12A, 11, 12, they come in the order next, so that is second regime. Okay. So what they say, for the purpose of, they propose to rationalize the provisions related to both the regimes. Okay. And what is their purpose? Purpose is effective monitoring. Now I'll stop here for a 1 or 2 seconds and would like to highlight this word. The effort of department over the years has been regulating the things very closely or monitoring the things very closely. And one has to be careful when the department is using this word. So one has to, or when you are advising trust clients, you have to advise that they have to follow the provisions of the law in proper spirit, properly. Say they have to follow them properly and strictly. That is what I understand. Then second object is bringing consistency. That is what they have done. Most of the provision now they are on parity. That is provisions related to 1023C, certain provisions or certain related provisions which were there in 11 and 12 were not there in section 1023C. Now they are almost on the same footing, barring 1 or 2 exceptions that I'll talk about little later. And providing clarity. Yes, providing clarity. Certain provisions are there. What rate of tax to be charged and how to be charged and all that. That mechanism also they have provided while this amendment. I'm on page number 4, and now I move downwards. That amendment by Finance Act 22. Point number 1. Amendment to section 11(1). Okay. Amendment to section 11(1). That is the first. Now, as far as this these amendments are concerned, there are several amendments. So I am going as in the order of section, subsection in which they come in the law, in the act, actually, from the point of view of convenience of referring to or the convenience of presentation. But I have followed this mechanism. So section 11(1). Now, as far as these amendments are concerned, let me tell you one thing. Only section that is not touched in this amendment, according to me, is 2 subsection 52 clause 15. That is definition of the charitable purpose. That is not touched. That is not amended. And secondly, what is not amended is section 12. Barring that, you will see that there are amendments affecting to each and every section which is related to charitable trust or a religious trust. When I'm talking of charitable trust, it includes religious trust also. Okay. So first amendment, option to treat voluntary contribution as corpus donation in certain cases. So friends, you are aware this, pardon me for saying so, but this amendment seems to be with a particular intention in mind. Let us first see what is the amendment. And this amendment is with effect from assessment year 21-22. That is year that has already gone by. Year has already gone by. You cannot file return for that period. The time for filing return is over, and they have come out with this amendment in the budget of 22. And but this could be useful. This will be useful for certain trusts. Which are the trusts for which this will be useful? Now, what this amendment says, option to treat voluntary contribution as corpus donation in certain cases. Now, the trust receives voluntary contribution, but the trust has got an option to treat it as a corpus donation. What it says, where the property held under trust includes any temple, mosque, gurdwara, church or other place notified under section 80G2 clause B. Remember friends, notified under 80G2 clause B. So this is a particular subsection and clause. Here most of the trusts that generally we deal with will not fall. And the example that comes to my mind, the last notification I was referring to, one Somnath Temple Trust has been notified in year 22, and Ram Mandir, that is Ram Janmabhoomi Nyas, Ram Janmabhoomi Tirtha Kshetra. That Ram Janmabhoomi Tirtha Kshetra, friends, you are aware that in 20, that is the COVID year, the renovation of the Ram temple was started. The Prime Minister laid foundation stone and all that in August 20. I think this donation is this amendment is with respect to such trust only and will not benefit other trusts. That is my understanding. What this amendment says, it is the trust is holding a property which is a temple or a mosque or a gurdwara, means a religious place, which has been notified under section 80G2B. Okay, Ram Mandir Tirtha Kshetra Nyas has been, Ram Janmabhoomi Tirtha Kshetra has been notified, Somnath temple has been notified, and there are quite a few. But such places which are renowned all over India or renowned throughout the state have been notified, and small temples and small religious organizations and small temples do not fall in this category. In fact, the donation for religious purpose is not permitted, or they generally do not grant 80G. Okay, generally they do not grant 80G whenever there is a purpose is religious purpose, but a exception has been made here and for a particular purpose, and this provision relates to temples such as Ram Janmabhoomi Nyas. Okay, and what are the conditions? That donation has been received for the purpose of renovation or repair of such temple. You are aware, friends, as far as corpus donation is concerned, the general law or general understanding is that there has to be a letter. Donor has to give a letter stating that I am donating for this and this purposes. In case of Ram Janmabhoomi Nyas, say amounts were collected all over India, but then they missed out on taking, I feel so, they missed out on taking letters or donors letters. They just issued a receipt, and then subsequently it might have been noticed, and they have tried to cure that defect, and they have come out with this amendment. So they have given an option to the trust to treat voluntary contribution received may at the option of the trust will be treated as corpus donation. And conditions, what are the conditions? Similar conditions, more or less, with some concession. I'll tell you what are the concessions. First of all, the donation is to be utilized for the purpose which is for the purpose for which it is taken. It is taken for renovation of the temple. It is to be utilized for renovation of the temple. It is not to be donated to any other purpose. Then it is to be kept separately identifiable, and it is to be kept invested till it is utilized. It is to be kept invested in the deposits in the forms or modes specified under section 11(5). Okay, these are the conditions. Moving ahead, supposing these conditions are not fulfilled, supposing the amount is not kept invested, and supposing it is not utilized for that particular purposes, then that amount will become taxable in the year of breach. That is what this section says. Moving ahead. Well, I am on point number 2 now. I am on page number 5. And let me tell you, friends, that amendment they have brought in will come to the rescue of the organizations like Ram Janmabhoomi न्यास only, and it is not generally useful for any other trust. That is my understanding. Point number 2 is amount accumulated or set apart as per 11(2) has to be utilized for purposes for which accumulated or set apart within 5 years or the period of accumulation. Now here there was some confusion in the minds of income tax department. What was the law? The law was like that, supposing in this particular section, that is 11 subsection 2, that is second option. You are aware that for the purpose of if the amount that is received by charitable trust or religious trust, voluntary contribution which is received by charitable trust, or income which is received by charitable or religious trust, say 10 lakh rupees is received. So 85% of it has to be applied for charitable purposes, in simple words. So wherever there is a shortfall, there are two options emerging. One under section 11(1), that is carry forward for, generally I'm talking in simple terms, carrying forward for next year, and 11(2) option is carrying it forward for 5 years. Okay, set aside and accumulated or set aside. The wording used in law is accumulated or set aside. For the sake of simplicity, I am using the term as carry forward for future application. Now 11 subsection 2 option is carrying it forward for 5 years. Now the wording of the law was such that when the amount is carried forward for 5 years, it could be spent either up to 5th year, or it could be spent in the 6th year also. And if it was, I am talking of old provision, and if it is not spent up to 6th year, then 6th year it has to be offered to tax. Now they have changed this provision. What they say is, first of all, amount cannot be carried forward beyond 5 years, that is for sure, and amount has to be spent up to 5th year. So the amount is not spent up to 5th year, then in the 5th year itself it becomes taxable. This is what the provision says. So that window was there for spending in 6th year or the year. Supposing some trust can carry it forward, say it is not necessary that it has to be carried forward for 5 years. Some trust can say that we want to carry it forward for 3 years. When they are giving later, they making application in form number 10, they can say that 3 years. So the 4th year option, that is period is over, is not available, and the maximum period was 5 years. Spending in 6th year, that option is not available now. Assessment is applicable from the amendment is applicable from assessment year 23-24, that is the current financial year. From current financial year, this amendment will become effective. Now going further, point number into clause B. Subsection is further amended to clarify year in which amount accumulated or set apart shall be deemed as income. Now, friends, actually, if you see the old wording of the law, there was little confusion. Everything was bundled in one single line. And over the period of time, we has to bundle in the single line. And we used to understand it by practice or by years together. That practice has been followed and make out some sense out of it. That was the old provision. And to clarify that position, what they have come out with, they have made amendment to this particular subsection. And now what it says is, it was old law also, but they have put it in, they have clarified it, and they say that in the year of breach, the amount is taxable. What has to be done? In the section 1112, if the amount is carried forward for 5 years, it has to be kept invested. Okay, it has to be utilized for the particular purposes, etc. And it should not be paid to any other organization which is registered under section 12A, 12AB, or say 1023C, 4, 5, 6, 6A, etc. So whenever that breach happens, supposing that amount is carried forward for 5 years, but in third year it is paid to some other registered trust, then breach happens. Supposing it amount is kept invested, not utilized, but it has been withdrawn, the investment is broken, but the amount is not utilized for the purposes, then the breach happens. Supposing the amount is carried forward for particular purposes, let us say for medical purposes. So for purchasing some equipment, the amount is carried forward, but it is utilized for some other purposes, the breach takes place. So this section says, or this amendment says, that the year in which the breach takes place, that in that particular year, the amount is taxable. Earlier also we understood law in that manner, but now they have made it succinctly clear. So in the year of breach, if the amount is broken, investment is broken, it is not utilized, it is utilized from some other purposes. And what happens in the last limb? What happens when it is not at all invested in 5 years period? It has been carried forward for 5 years period maximum term, and it is not at all utilized up to 5th year. Then in that case, it becomes taxable in the last year, that is the 5th year. Okay, that is what this amendment says. This is a sort of, one can say, clarificatory amendment. This is again applicable from assessment year 23-24, that is from current financial year. Moving to point number 3, I am on page number 6. Application of income will be allowed on actual payment basis only, and not when provision is made. Friends, you should take a, you should be careful about this amendment. And this amendment is related to assessment year 22-23. Means this is applicable for financial year which has ended on 31st March 22. So this is another amendment which is applicable for a different year. So Ram Mandir is applicable. Ram Mandir donation, that is voluntary option. Voluntary donations can be treated as corpus donation, that is applicable from assessment year 21-22. And here the payment will be allowed. Means whenever the payment is made, that has to be actual payment that should be made, and provision will not be allowed. Now let us consider a case. As far as small trusts are concerned, we generally, small trust means trust registered under Societies Act 1860 or trust registered under Maharashtra Public Trust Act. It does not say, these laws do not say that you have to, that trust or the organization has to follow a mercantile basis of accounting. But when we come to Section 8 companies, Section 8 company being governed by the Companies Act, the accounts are to be maintained on mercantile basis only. So there could be a problem. So as far as Section 8 companies are concerned, and where the trust or societies which are following a mercantile basis are concerned, there they will be affected. These trusts affected for that particular year. So unless and until the income will be accounted for on the as per as mercantile basis, sir, due or accrual basis, due and accrual basis. So amount received, amount due, amount accrued, everything will be treated as income. Okay, but as far as the amount applied is application is concerned, supposing only 7 lakh is spent out of that and 1 lakh provision is made, that 1 lakh provision will not be considered for the purpose of application during that particular financial year. When the amount is paid, maybe in subsequent year, that time it will be allowed. But when the amount is not spent and only provision is made, then that amount will not be allowed as by way of application. So this is a major amendment, and this is applicable for assessment year 22-23 and will be applicable, and you have to consider for filing the returns which are due now. Okay, moving ahead. Now here, point number 4, page number 6. Okay. Conditions for maintaining books of account and other documents added. Friends, you are aware that whenever income exceeds maximum amount not chargeable to tax, that is about 2,50,000 in case of trust and societies, etc. Then in that case, the accounts were required to be audited. Then audit report in form number 10B is required to be submitted before filing of return and all that. Due dates are date of filing. You are aware that in case of audit, it has to be 30th September and the return has to be filed by 31st of October. That you are aware. Here there is a addition. There will be an additional requirement now. Such trust where the income exceeds maximum amount not chargeable to tax without claiming benefit under section 1112 means, in simple words, gross income. Gross income exceeds 2,50,000, which was the provision for filing return also, and which was the provision for filing audit also, and limit. And here the books of account to be maintained. Now, what kind of books of account to be maintained and what are the documents to be maintained, that they will come out with the rules. As far as my knowledge goes, so far they have not announced anything, or they have not come out with any notification, etc. So we have to wait what kind of books of account trust have to maintain, and what kind of documents trust has to maintain. We'll have to wait for this, but this is one important amendment one has to keep in mind, and this is applicable from assessment year 23-24, that is from current financial year. Moving ahead, point number 5, cancellation of registration. Okay. Point number 5, cancellation of registration. Here, friends, there is a revamp of this provision. What was there earlier, the major changes have been introduced or major amendments have been made to this provision. We are aware that provision related to registration were changed. The whole process has become online now, and we are aware that earlier the registration was there for perpetuity, but the registration is now, or approval will be there for only 5 years period maximum, and they have introduced a provision of provisional registration for 3 years also. What they say, the memorandum to the budget says the following issues related to process of approval or registration or cancellation or withdrawal thereof have been noticed. Namely, what? The registration or approval of non-genuine trust or institution under automated approval system. They say registration or approval of non-genuine trust or institution under automated approval system. They say provisional registration or provisional approval or registration or approvals in certain cases under these clauses are granted in an automated manner, and the respective rules have been amended accordingly. It is essential to ensure that non-genuine trust or institution do not get exemption provided by this provision. So that is their purpose. Non-genuine trust or institution under getting approval, they want to control this, and for this purpose, they means income tax department. For this purpose, now they have made amendment to section 12AB, and subsection 4 and subsection 5, which covers this amendment, they are substituted and with effect from 1/4/22. And according to me, 1/4/22 means with respective date. So everything from 1/4/22 will go under this amended subsection 4 and subsection 5. Now, what are the scenarios? What are the scenarios here where registration or provisional registration is granted? Means both. Either it is registration or provisional registration granted under section 12AB or section 12A. Actually, now 12A is not relevant, but they have kept it there. Now mostly all the registrations are, according to me, they should be there under section 12AB, or then 1023C also they have made a similar provision. We will come to it little later on similar lines. 12AB. So wherever registration is granted, For 5 years, a provisional registration is granted. These provisions can apply. Now here, principal CIT or CIT notices one or more specified violations. What are the specified violations? They are given subsequently in explanation. So either principal CIT or CIT directly notices, or principal CIT or CIT has noticed some reference from AO that AO is satisfied that there is a specified violation committed by, there is a specified violation by the trust. So either principal CIT or CIT can notice directly and suo motu he can start the action, or he has come to the notice by a reference made by AO. And subsequently, third clause which can trigger this is a case has been selected in accordance with the risk management strategy. So these are the three scenarios in which this process first of all can trigger. And I'll first go to specified violation. Explanation given here. It says what are the specified violations. Please come to explanation. Specified violation. Now specified violation says, now here one has to be very careful. This was not there under old law, and this is a new feature in this amendment. One has to be very careful. It says income derived from property held under trust is applied other than for the objects of the trust or institution. Means what? The objects of the trust are, let us say, educational only. Okay, the objects of the trust are educational only, and they apply the income to medical objects. Objects are educational, but the trust applies income to educational object. So supposing, even though it could be a charitable object, medical, relief to poor, etc., all say 6-7 objects which are given in the 2 clause 15 could be charitable. They are charitable, but supposing they are not incorporated in the trust deed, they are not included in the object clause by way of the trust deed, or the society's memorandum, they are not, the society's memorandum does not consist or does not include these objects, and the amount is spent for other object which is otherwise charitable, but it is not there in the instrument creating the trust or document governing the trust or institution. In that case, this this clause or this problem can be there, and this violation would be there. So trust has got some object charitable, but they have applied to some other objects, remember. Then secondly, now this is again a nasty part. Say they have been trying, what it says, B, trust institution has income from business which is not incidental, or business is incidental but separate books of account are not maintained. Friends, they have been trying, the department has been trying to bring into taxable ambit the business income. Actually, there are section 11 subsection 4, that is business undertaking held by the trust, 11.4, and 11.4a other business income. Okay, there they are not making any amendment at all. They have started making amendment in 2 clause 15. They have made a provision that first of all they made a provision that any commercial receipts are there, then the trust will lose the benefit. That came in somewhere in the year 2008 or 2009. Then they introduced a limit of 10 lakhs. Then they introduced a limit of 25 lakhs. Then subsequently, now that how that 2 clause 15 stands as, any commercial activity, if the receipts are more than 20% of the gross receipts of the trust, then in that case that particular income will be taxable. Okay. Now here what they say is, it can trigger cancellation provision now. So it says income from business is there which is not incidental. So now one has to take care that trust is having a business, they are having a income from business, that has to be the income, business has to be incidental. Now what is business incidental? Business, when that business can be considered incidental? According to me, that 30 trust decision of Supreme Court is still valid. According to me, whenever there is an income from business and it is applied to feeding charity, or that amount is utilized for the purposes of carrying out charitable objects, that business will be considered as a incidental business. That is 30 Trust Supreme Court judgment says. According to me, it can be applied here. And business, wherever there is a business income and then that amount has been utilized for the purpose of carrying charitable objects, then it has to be treated as business which is incidental. Then secondly, second part of this violation clause says business is incidental, but separate books of accounts are not maintained by such trust or institution. So two precautions the trust or institution has to take. First of all, they have to see that whatever income from business is there, it is applied for charitable purposes or religious purposes for which it is registered. Secondly, books of accounts are required to be separate books of account for such business income are required to be maintained by such trust or institution. If the conditions are not satisfied, the cancellation provision can trigger. Now, subsequent clause is there, that is clause C is there, trust or institution has applied its income to private religious purpose. It was there, so amount is applied for private religious purposes. The benefit of exemption was not available, but here now it can go. There can be a cancellation because of this. And a trust or institution established for charitable purpose after 1/4/1962 and applied its income for the benefit of a particular religious community or cause. It was there in section 13 earlier also. Here it can trigger a provision of cancellation now. Okay. Going ahead, any activity carried on by the trust or institution is not genuine. This was also there for cancellation. This condition was also there. What is new? Now this is new. Any activity carried out by trust or institution is not being carried out in accordance with all or any of the conditions subject to which it was registered. Now, friends, you are aware, or you may be aware that whenever new registration process was started, I'm on page number 7. The new registration provisions were started. At that time, the approval letter or approval order or registration order was issued with so many conditions, and about 15-16, if I'm not mistaken, 15-16 conditions were there, and even there was a condition where asset is acquired, any fixed asset is acquired, then their intimation has to be given to the income tax department. When there is a change in trustee, there also intimation has to be given to the income tax department. All such numerous conditions were there. Now some better sense has prevailed, and they have issued a notification of late, some 15-20 days back only. They have issued a notification. I don't remember the date now. Yes, here on 3rd June 22, they have issued a clarificatory circular. And what they have done is, in that clarificatory circular, they have said that conditions for what would be the conditions subject to which registration is granted. These are the conditions, which are the specified violation are stated that income from the property to be held for the property held for charitable or religious purposes, that has to be utilized for that particular object for which the trust has come into existence. It cannot be utilized for some other purpose. So all these specified violations are there now. They will be treated as conditions. They are matching now. So whatever are the specified violations and the conditions contained in, they have said that by the new circular that they have been issued, the conditions will be in line with the specified violation. So for these violations only, which have been stated as specified violation under section 12 AB 4, these are the conditions subject to which the registration has been granted. And if there is any breach of these conditions, then the cancellation provision can trigger. So this is a good clarification that Income Tax Department has provided. Going ahead, last part, that is F clause, subclause F, that trust has not complied with the requirements of any other law as are material for the purpose of achieving its object, and the order, direction, decree, etc. has become final. Say, friends, this was also there under the old law, under old cancellation provision, this was there. Now I come to what is the action principal CIT has to take, middle part of the page number 7. Okay, principal CIT, middle part of the page number 7. Please. Okay. Now, supposing a violation has been noticed, then what the action will be? Principal CIT, like say we have a process of registration, that is elaborate position of provision of verification for registration. You must be aware, for 12A and ATG we used to go through that process, submission of the document, the CIT used to call for information and all that same process. So the CIT, principal CIT or CIT can call for such document and information from the trust or institution, and he can make inquiry as he thinks fit to satisfy himself, and he has to grant a reasonable opportunity before passing any order. Now, order he can pass either for cancellation of registration, or he can maintain a status quo. He can either cancel a registration and pass an order accordingly, or he can say no violation, according to him no violation has taken place, and so the registration has not been cancelled. Both the options are there. Principal CIT means, friends, please keep it in mind, just because the process is started, the notice is issued by the principal CIT for calling for information and document and all that the obvious consequences will be cancellation of registration. No, it could be cancellation, or it could be continuation, refusing to cancel also. And a copy of the order, when order is passed, it has to be given to AO as well as to trust or institution. And what is the time limit? Time limit is 6 months from the end of the quarter. Time limit is given in 12AB 5. The time limit for passing the order is, it has to be within 6 months from the end of the quarter. Means, for example, friends, let us say for April, May, June. In April, May, June, in this quarter, the notice has been issued by principal CIT. Now, principal CIT has issued notice in first quarter, April, May, June. So thereafter 6 months will be available for passing the order. So by December, the order can be passed. Okay. Provisions are applicable from first of this financial year, that is 1/4/22. Now, amendment to section 30. Just a moment. Here, I am on page number 8. Now, how much time is there? It is 12:15. Okay. We have sufficient time. No problem. Amendment to section 13. Page number 8. Now here, subsection 10 and 11 have been inserted. And what they say, how income chargeable to tax to be computed in specified cases. Now, there used to be a controversy in case of certain breaches or non-compliance of the provision of the law. Here they say their object was there to provide clarity, so certainty or clarity. Here I agree with the department. What they have said, that how income chargeable to tax to be computed in specified cases. And what are these specified cases? There are 4 scenarios. One is section 2 clause 15 is attracted, means commercial receipts commercial activity has got receipts which are more than 20% or exceeding 20% of the total receipts, and benefit of exemption under section 11 and 12 is denied to the trust. This is first category which can attract this specified calculation mechanism. Then secondly, trust does not maintain books of account. That I have mentioned that they have brought in this amendment just now and is effective from this current financial year. This provision is also effective from current financial year only, financial year 22-23, assessment year 23-24. So books of account are not maintained, books of account are not audited, audit report is not submitted, and if the return is not filed in time allowed under section 139. Under section 139 will include belated return and time for belated return as well as revised return. section 139. Okay. So here, so these are the 4 categories. First of all, 215 is attracted. Okay. And there is a breach. Then secondly, books of account not maintained. Thirdly, audit report, audit is not carried out, audit report not filed. And fourthly, the return is not filed, and this maintenance of books of account, books are not audited, return is not filed. These are all applicable where when the income exceeds maximum amount not chargeable to tax, not otherwise. Okay. So if the income is less than 2,50,000, then these provisions are not attracted. But the income is gross receipts are above 2,50,000, then these provisions are become squarely applicable. Then what it says further, moving further, it's income chargeable to tax, how it has to be computed. Now they say that only revenue expenditure will be allowed, and it should be for the achieving objects of the trust. Now the question here would be, first of all, capital expenses will not be allowed, only revenue expenses, and revenue expenses which are spent for achieving objects. The question mark here would be whether the administrative expenses will be allowed or not. That we will have to see what department, how the department treats such cases. Earlier it has been held that as far as for the purpose of calculating application for section 11(1)(a) and B, etc., it has been held, or it is considered that expenses on administration, etc., are allowed. But where the department will allow expenses or administration, or whether it will stick to this particular wording that the expenses should be for the purpose of achieving objects or amount, allowing expenditure, revenue expenditure only, which is for the purpose of achieving objects, or spent for the purpose of achieving objects, that one has to see. So I am not very sure, but according to me, the department can take either of this stand, and there can be litigation on this point. But the provision stands today. They say the expenditure has to be revenue expenditure, and expenditure has to be in India, and expenditure has to be for the purpose of achieving object. Secondly, there are certain conditions that they have introduced. What are the conditions? That expenditure is not from corpus donation. I have explained to you that corpus donation stands on separate footing and it should not be mixed up. So there should not be expenditure out of corpus donation. Then secondly, expenditure should not be from any loan or borrowing. Thirdly, depreciation is not claimed. Friends, you are aware that they have made amendment to these provisions. So whenever asset is acquired and you are claiming that capital expenses as an application, there the depreciation cannot be claimed. But this section itself says that revenue expenses can be, only revenue expenses will be allowed. To my mind, what can happen is, supposing in past trust has acquired an asset, and they have not claimed that total amount, that is amount spent for acquisition of asset has not been claimed, and they are continuing. They are claiming rather depreciation year on year. Their depreciation will be allowable according to me. So depreciation is not claimed where the cost of acquisition of asset is claimed as application, and expenditure is not in form of any condition, contribution or donation to any person. So these are the 4 conditions. Okay, it should not be donated to any person. It should be out of corpus donation. It should not be out of loan borrowing, and no depreciation should be claimed if the entire cost has been claimed as application. So this is how the provision stands. Now, how income has to be computed further? Moving further, TDS provisions to be complied with. Secondly, any expenses in cash exceeding 10,000 rupees will be disallowed. That we are aware. They have brought this provision in the main sections, and similarly, they are introducing those provisions here. So if the TDS is applicable, the TDS provisions have to be complied, and 48.3, 48.3a, and say 48.1a. All these provisions have to be complied with. Okay, and no other deduction. New subsection 11 states that no deduction under any of the provisions. Means this is compartmentalized. What they have stated in this particular subsection that we have to follow in this peculiar scenario, return it not filed, audit report is not filed, etc. But one solace is, one saving grace is, the tax will be chargeable at normal rate. Earlier there was a confusion in the minds of department. They used to helter-skelter charge 30%, that is maximum marginal rate in some cases where it was really not applicable or where it was really not permissible. But here it clarifies, it says, or I understand that tax will be chargeable at normal rate. Then nothing has been said that the tax will be chargeable at special rate. So tax will be chargeable at normal rate. Now moving ahead, page number 9, we are almost coming to a conclusion or concluding part. Here, page number 9 and point number 7. Okay. New section 11 BBI inserted to provide for tax at 30% on specified income. I said earlier that that provision is there, earlier provision that we discussed, tax at normal rate. Here now they are saying that tax will be charged at 30% on specified income, plus there will be applicable surcharge, plus whenever applicable, and education cess. So 30% plus surcharge plus cess will be the tax rate, and it will be when that scenario will happen, 30% on specified income. And what is the specified income? Here we move ahead. Here explanation, by means of a explanation, just move down to foot of that page. Explanation: for the purpose of this section, specified income means, now here there is slight change, or there is some change from what we have been understanding years together. Earlier, friends, let us try to recap. When the tax rate of 30% or maximum marginal rate was applicable, one, anonymous donation. In that case, tax rate of 30% was applicable. That is applicable here also. It is not mentioned here. That section stands separately. So that was there. 30% tax was there in anonymous donation. Secondly, 30% tax was there when there was a 13(1)(c), breach of section 13(1)(c) and 13(1)(d). What is 13(1)(c) and 13(1)(d)? 13(1)(c) is a payment to specified person. The excessive benefit is granted to specified person, that is trustee or its relatives, manager or its relatives, etc., or founder of the trust, etc. So these specified persons are there, and any unreasonable benefit is granted. And what is that unreasonable benefit? That is also given in section 13. Okay. Any excessive remuneration is paid to that trustee, etc. So these are there no amendment is made. Now here it says, here it includes that 13(1)(c) and 13(1)(d). There used to be a confusion in the minds of department, and the cases have been fought up to Supreme Court. In Buller Charitable Institution case, Karnataka High Court gave a decision that investment have been made by the trust which are in breach of section 13(1)(d), but entire income cannot be taxed at the rate of 30%. Where there is a income from such investment, that income only is liable to be taxed at 30%. Department did not agree with this. The SLP was filed in Supreme Court, and the SLP was rejected. So the provision of the law, the understanding and conclusion is, in case of 13(1)(c) or 13(1)(d) breach, what should be the scenario? Only the income which is in breach of this provision and not the entire income of the trust should be taxable at 30%. They have included these cases here. If you see clause number C of this explanation and D of this explanation, which talks about 13(1)(d) and 13(1)(c) breach. So fair enough, which was there earlier, which was earlier also taxable at 30%. Here also it is taxable at 30%. What is not fair, or what they have done now, are the portion which I have highlighted, and I'll go through it now and I'll explain it. Say income accumulated, first clause A, income accumulated or set apart in excess of 15%, where such accumulation is not allowed under any specific provision of the Act. Okay. Second part also I will do. Deemed income referred to in explanation so and so, section 11, subsection 1b and section 3. I'll take clause B first. That is what that is what that is the case of, say you are aware, friends, when 85% of the amount is not spent, that shortfall is there. Supposing 75% of the amount is spent out of income, 10% amount is not spent, that amount is to be included in the total income. It is not entitled directly to the benefit of exemption. Agree. Say out of 10 lakh rupees, say 8,50,000 was to be spent, and say 7 lakh rupees have been spent. So 1,50,000 is liable to be included in the income. So that is what is said by 11 subsection 1b. So 1b and 3. So two options were there. Either you can carry forward to next year, okay, or in simple words, or you can carry it forward for 5 years. So when the amount is carried forward to next year, or when the amount is carried forward for 5 years, and the conditions are that amount has to be spent in that next year, or the amount has to be spent in that up to 5th year, the amount has to be kept invested, etc. So supposing any of the conditions which are either as per section 11.1, which is of spending in next year generally, and 11.2, which is spending in 5 years or keeping it invested and utilizing for that particular purpose only, if there is a breach of any of these conditions, earlier only income was liable to be taxed. Earlier the income was liable to be taxed at normal rate, but now the income will be liable to be taxed at the rate of 30% in this scenario. So this is the change from previous year, that is last year, unamended position and amended position. Now going to clause A, which says income accumulated or set apart in excess of 15% of the income, where such accumulation is not allowed under any specific provisions of that. Means what? They are not spelled out. It stops at that. It could be form number 9A not filed. You want to carry forward, trust want to carry forward income for 1 year. Say this year there was a shortfall. So either form 9A is to be filed, or form number 10A, the form number 10 is to be filed. So if such form is not filed, supposing the return of income is also not filed, so in this scenario also the benefit of set off or carry forward and the exemption benefit will not be allowable. And if such benefit will not be allowable, the respective income will be liable to be taxed at 30%. That is what it says. And another addition here which I have highlighted is the last clause, clause number E, that is any income which is not included from the not excluded from the total income under section 11.1c. What is section 11.1c? Section 11.1c is a spending in foreign country. It is generally not there in case of most of the trust, and where it is there has to be specific permission, specific approval from the CBDT. Either general permission has to be there, or special permission of CBDT is there on the application made by the trust. Then only the income will be claimed exempt under section 11c. So this is a peculiar scenario. In 99% cases it will not be there. Most of the trusts are applying their income within India. So this case is for the purpose of where the income is to be applied in the foreign country, and whether when that is to be allowed by way of general or special order of the CBDT, then only this scenario is attracted. And supposing approval of CBDT, so trust has applied income in a foreign country, trust has made spending in the foreign country, and approval of CBDT is not taken, then in that case the income will be taxable at 30%. That is what this amendment says. So friends, say to summarize, form number 9A not filed in time, form number 10 not filed in time, conditions for carry forward for either 1 year and spending in next year, and conditions of carry forward for under section 11.2, that is to keep it invested and utilize in 5 years, etc., are not fulfilled. And say 13.1c default is there, amount spent or salary paid to a trustee, etc., which ITO AO considers to be unreasonable, a substantial benefit has been granted or benefit has been granted, that is what AO considers under section 13. Then 13(1)(c) and 13(1)(d) is attracted. 13(1)(d) is what? Say investment is made, investment is not made as per section 11(5). Investment is made in some other form, not as per form permitted as per 11(5). Then income is there from such investment which are not in permitted mode. Then this clause can trigger, and this income will be liable to be taxed at 30%. According to me, as far as 13(1)(c) breach is there and 13(1)(d) breach is there, there is a absolute clarity brought in or introduced by this amendment. But it is roping in, bundling it. It is including other few breaches also. That is a matter of worry, or that is one should take note of. Moving ahead, I am on, this is literally the last important amendment related to second regime. Page number 10. Page number 10. I am on page number 10, and section 271 AAE. Now, friends, we were talking about 13(1)(c), 13(1)(c) breach, that any benefit is granted to specified person, etc. And then their taxes attracted at 30% plus surcharge plus EC, etc. Here also there is a additional, there is a penalty for such default. So it says, if during any proceeding it is found, proceeding under the act, it is found that any fund or institution has granted any unreasonable benefit, okay, unreasonable benefit to the trustee or say specified person, the trustee, manager, their relative, etc., and founder member, substantial contributor, etc. In that case, this provision can trigger, and if the benefit AO comes to the conclusion that it is a unreasonable benefit has been granted to such person, then sum equal to 100% of the amount of income applied directly or indirectly for the benefit of such person has to be paid by way of penalty. Now here there can be two scenarios. One, the AO can slap penalty of the entire amount that has been spent, or AO can slap the penalty of the amount in his view is excessive. The benefit is excessive. That what they do is what AO does, we have to see. The provision is either 100% when the violation is noticed for the first time, and in the subsequent year or subsequently violation is noticed, then the penalty can be 2 times, that is 200% of such amounts. And how the amount will be calculated, according to me, where the benefit is granted, where the excessive benefit granted, unreasonable benefit granted, then only this provision can trigger. But what could be the amount, that only time will tell. And the last part, last thing which is important related to this amendment is the penalty is in addition to any other penalty. So supposing any other penalty is leviable under the law, then that penalty is applicable. Plus this penalty is also applicable, could be levied. So applicable with effect from assessment year 1/4/23. So assessment year 23/24. Okay. And power is given to AO. Now, moving ahead. So friends, I have covered all the amendments which are related to section 11, section 12A, then section 13, 12AB, etc. That is what department says second regime. As far as my knowledge goes, my reading of the clauses or the act and the relevant section goes, that first regime and the second regime word they have used only in memorandum. They have not used this word in the specific sections or specific amended clauses or sections or subsections. So it is for the section, it is for the purpose of ease of understanding only, second regime and first regime. Now we come to what are the provisions which are applicable, amendments which are applicable with respect to 1023C. Remember friends, All these amendments are with respect to trust falling in 1023C subclause 4, 5, 6 and 6A. 6 and 6A are educational institutions or hospitals where their gross receipts are exceeding 5 crore rupees. Okay. And 4 and 5 are there, 1023C, 4 and 5 are certain charitable institutions or the trust which have been notified, which have been approved for purposes of section 1023C 4 and 5. They are mostly famous trust or big trust. So mostly we will be concentrating on 1023C 6 and 6A. Okay. So here option to treat voluntary contribution as corpus. We have discussed at length, say what this means. This is for the trust like Ram Mandir, Janmabhoomi Nyas, and this is such trust which have been notified under section 80G to be similar. What we have discussed under section 11 for the purpose of 11, section 11 we have discussed. Here this is similar amendment has been made here, say 1023C. Option to treat voluntary contribution as corpus donation. Same footing, similar conditions, everything same, ditto. Now here, I am on page number 11. Page number 11, item number 2. Here in the third provision, after this I will not read this relevant clauses, sub clauses and all that. It will be too much for remembering. Page number 11, item number 2. Okay, where 85% of the income is not applied to the object for which it is established. Say friends, here a amendment has been made and the parity has been brought as far as the first regime and the second regime is concerned. We are aware that 9A and form number 9A or 10 is to be filed for the purpose of carry forward. As far as section 1023C is concerned, there are two options are not there in section 1023C. 1023C talks about only one option, that income can be carried forward for 5 years. Okay. So that is now the difference between, that is one difference between 1023C and section 11 benefit. Okay. So carry forward for 5 years only is the option, maximum period of 5 years. Next year, carrying forward for next year is generally not there, but then when you are carrying forward for 5 years, that is understood. That is understood that next year also you can spend. But literally speaking, that option is available. That is up to carry forward is for up to 5 years. Now this carry forward was without any condition of filing statement like we are required to file form number 10 in for the purpose of section 11(2). But here this condition is now introduced from assessment year 23-24. That means for current financial year, wherever, that means the return you will be going in next that is after in the next calendar year return will be going. So here for current financial year, that statement to be furnished to AO is similar to form number 9A and form number 10. Actually they have not prescribed which will be the form. Okay, for whether the form 10 will be usable or what, they have not prescribed. So we have to see. I think they will come out. There is a lot of time for this, but one has to remember that now the claiming benefit of carry forward is not automatic. You cannot directly claim in 1023C 6 and 6A cases. There the statement has to be filed like second regime, that is 11(2). We file form number 10 similar to that. Similar, now provisions are similar. The person has to specify the purposes, that is assessee has to specify the purposes for which it is spent, then the period for which it is to be carried forward, etc. Okay, and conditions are also similar. The money so accumulated has to be invested. I stated that conditions are similar. Money so accumulated for 5 years has to be kept invested in the specified mode under section 11(5). I am now moving to page number 12. Okay, page number 12. Similar footing. If there is a breach if there is a breach. Okay, breach means what? Amount is carried forward for 5 years. Okay, and it is not utilized for the purpose. If it is not kept invested, the investment is broken, it is applied for some other purposes, then the breach happens. Or it is not at all utilized for purposes for which it is carried forward or accumulated. In that case, year in which the income is to be held taxable. Here they have similarly clarified, similar to second regime, they have clarified year in which breach takes place. So amount investment is broken, 5 years it is carried forward, amount is invested. Amount is invested, but invested is broken mid 5 years, somewhere in third year, investment is withdrawn. Then in that case, breach takes place. Supposing it is not utilized for any purpose for which it is carried forward, breach takes place. So supposing it is up to 50 year it is not utilized, then breach takes place. So here in this scenario, which year in which it is liable to tax? Year in which breach takes place, it is liable to be taxed. That is what this provision clarifies. And in case for full 5-year period, the amount is not utilized and it remains to be utilized, then in the 5th year, the amount has to be brought to tax or amount has to be included in the total income of the SSE. Similar footing, what we saw under section 11, this is in similar footing. Moving ahead, new explanation 5, page 12 only, new explanation 5 inserted. Now here, supposing here again parity tried to be achieved. These similar provisions are there in the second regime section. Under section 11, similar provisions are there. So here they have introduced these provisions by way of new explanation. What they say, circumstances beyond the control of the SSE, the amount kept invested but could not be utilized for the purposes for which it is accumulated, then AO, when the application is made by the trust for permitting user for some other purposes, AO can allow use for such other purposes. That is there in a second regime. They have brought this provision in the first regime. Only thing is, this amount cannot be, AO cannot permit it to be given to another trust which is registered under section 12AA or 12AB. Okay. Or the trust which is referred to under section 1023C. So the amount, when amount is not utilized or could not be utilized for say peculiar circumstances or circumstances beyond control of the trust, then AO can permit user for some other purposes, but AO cannot permit that it cannot be donated. It cannot be donated to another trust which is registered under section, either under section 12A or 12AB or under section 1023C, 4, 5, 6, 6, 8. Moving ahead, page number 13. Page number 13, conditions for maintaining books of account and other documents. Similar. What we have discussed, conditions for maintaining books of account and other document is added, and we are expecting that there should be some rules, or department will come out with some rules. They say keep and maintain books of account in such form and manner. What would be the form and manner? Now we'll have to see what kind of rule they introduce, and then only we can discuss this out. But we have to keep it in mind that something will come in this respect, that trust has to maintain books of account whenever their income exceeds the maximum amount not chargeable to tax. Similar. Now page number 13, item number 4, or Roman 4, small Roman 4. Amendment to provision. Okay. Amendment to provision for cancellation of approval. 15 provision is substituted. This is again on similar footing. What we have discussed for the second regime, everything stands like that. Similar, ditto, copy to copy, no change. The principal CIT has power for cancellation, and the reference, either principal CIT can suo moto can start that process if his notices specified violation, or the specified violation has been brought to his notice by the AO, or supposing the case is selected for scrutiny. So in these three scenarios, these provisions can trigger, cancellation provision can trigger, and principal CIT can start that process, call for that information in case of specified violation. The principal CIT will see that whether there is a violation or not, he will grant an opportunity, etc. Same. As we have seen in second regime, same, that is copy to copy. Specified violation that we have seen. Now, here these specified violation are there. I have discussed that some violations were there earlier also for which cancellation could trigger, but they have introduced some new violations. And as I have said, the trust is established for some particular purposes and spending on some other purposes. That is the violation that can trigger. Business income is there, which is not incidental. Business income is incidental, but separate books of account are not maintained. Here I would like to discuss, there are about 15 minutes. Okay, we are almost completed. Here I would like to bring to your notice, there are as far as section 2, clause 15 and provisos are there. The right, left and center, the department has tried to rope in or tax the income which is there purportedly from income from business, or treating any activities carried out by the trust, and then it is treated as income from business or profession, then that 20% criteria is applied, etc. And department has tried to bring it under taxable net, and so many cases are fought. And one case that particularly I want to bring to your notice, in fact we have included it in WRC book that we came out last year, that is GIDC. I would strongly advise you, all of you, to go through that GIDC judgment on GIDC delivered by Gujarat High Court. So case of GIDC is like this. GIDC is like MIDC. It is established for the purpose of securing orderly development of industries in the state of Gujarat, rapid industrial development in the state of Gujarat, and it is acquiring land and allotting land to industry, and it is collecting rent, it is collecting premium, etc. The department tried to treat that the organization is non-charitable, but High Court has held the activity is for the general benefit of public, that is it's a beneficial to general public, and as such it is for industrial development, and we consider it as a beneficial to general public. And they have rejected the department's contention and held that it is not a business. Department cannot say, it has struck down the claim of the department. So we have to take a stand in such cases, as I have discussed. In case of antitrust case, I have discussed that business income is there. If it is used for feeding charity, and then we have to say that no, it is we are using the business income for feeding the charity, so it is not these provision 215 provisions are not attractive, provisos are not attractive. That is what the stand one will have to take going further. But there are quite a few judgments on this subject, and they could come in handy for you. Time limit for passing the order, I have said that time limit for passing the order in April, May, June, the notice is issued. Then starting from July onwards, further 6 months are there available to CIT to pass the order. And what if moving ahead, page number 14, intimation by AO. Intimation by AO under old provisions up to 31st 22. What if any old notice has already been issued, procedure has been for cancellation, the procedure is underway, cancellation or otherwise, the procedure is underway under the old law. Violation has been noticed. Under old law also there were cancellation provision, notice has been issued under old law, and the order has not been issued up to 31st March 22. Then what happens? Like say we had a case of registration provision. In registration, whatever pending applications were there, they will be treated as application under new law. Similarly, all the cases which were there pending on 31st 22 under section 1023C, where the cases were pending for cancellation or decision was not taken, those will be considered to be cases that reference has been made on 1st April 22. Means it will be considered that April, May, June is the period in which notice has been issued, and the order for cancellation or refusal to cancel can be passed up to December. Moving ahead, item number 6, ninth proviso, foot of the page, page number 14. 19 proviso. Hey, actually here this is a only cosmetic amendment. They have simply tried to change it. That is, notification powers were there as per the old section with central government or prescribed authority. Now they have mentioned there that power of approval will be with the principal CIT. So this is just a cosmetic amendment or a clarificatory, I can say. And further, as per new explanation, now I am on page number 15. Okay, 7-8 minutes are there. Page number 15. Further, as per new explanation. Okay. This is also on similar footing. We have under section 11 and 12. Here they say if the approval or notification is granted under 1040C or approval is granted under 1023C. So either of that. So here the benefit under both the sections cannot be claimed. So you should be aware, the friends, you should be aware that benefit at any particular point of time is available either under section 11 or either under section 1023C or either under section 1046. 1046 is a very peculiar case, but either it is available under 1023C or under section 11. That one has to remember. Moving ahead, item number 7, new 20th provision, return of income to be filed. Similar. Return of income where income exceeds maximum amount not chargeable to tax, the return has to be filed as per time allowed under section 139. That is, belated return is allowed, revised return is allowed. And next is 8, new 21st proviso, that is benefit to persons specified under section 13.3. Similar, excessive benefit is granted to any specified person. In that case, it shall be deemed to be the income of the previous year in which such benefit has been granted. Moving ahead, 9th item, income, how income chargeable to tax to be computed in specified cases. Here also similar to what we saw under second regime, here under first regime also, if books of accounts are not maintained when required, books of accounts are not audited when required, audit report is not furnished when required, return of income is not furnished when required, and clause 15 proviso is attracted, means that business receipt from commercial activity exceeds 20% of the total receipt. In all these 4 scenarios, the income will be taxable in a particular manner at normal rate. At normal rate, I have said. And here similar, only revenue expenditure on object amount should be spent in India. Capital expenditure will not be allowed. And moving ahead, page number 16. Page number 16. Okay. And page number 16. Similar conditions that expenditure should not be out of corpus donation, corpus amount standing to the credit of the SSC at the end of the last year, previous year. Such expenditure is not from any loan or borrowing, and depreciation is not available when the cost has been claimed as application, and expenditure is not in the form of any contribution or donation to any trust registered under section 12AA, 12AB or 1023C, etc. Then that is cash payment in excess of 10,000 will not be allowable, disallowance will be there, TDS provisions will be complied, same. And moving ahead, new 23rd provision, it also says that deduction under no other section, no other provision deduction will be available, means whatever deductions are available are specified here only. You can't go elsewhere and claim any other deductions or set off, etc. Moving ahead, item number 10, page number 16 only, item number 10, application of income will be allowed on actual payment basis. Now this is again an important amendment you have to remember. and this is applicable for the previous year that has gone by. That means the return that you will be filing, for that this provision will be applicable for the year ended 31st March 22. The application will be allowed on actual payment basis only. When the provision is made, the amount will not be treated as application for that particular year. Now, one BBI section is there, item number 11. One BBI section that I have discussed, that in certain scenarios, the amount will be taxable at 30%, and 13(1)(c) breach, 13(1)(d) breach, amount is not spent on the object, etc. Okay, and 11(1)(c). Here, only thing is here 11(1)(c) will not attract. Spending in foreign country will not attract, but all other cases will attract, will be attracted. 115 BBI. Then 271 AE, the penalty. That is, this 1 BBI and 271 AE are there. They are across the board. They are applicable for first regime as well as second regime. Last thing of the presentation. Amendment to section 115 TD, TF, 115 TF. See, friends, these are provisions related to either merger or the trust merges with some entity which is not eligible for registration or not entitled to more benefit under section 11, 12 or 1023C. These provisions were not applicable earlier. 115 TD provisions, that is exit tax, we can say. Tax which is liable when the trust is closing, merging, dissolving, etc. The tax was to be paid at 30%. Then here, these provisions were not applicable to cases under section 2023C 4, 5, 6, 6A. They have been made applicable to these cases also. So here also parity has been brought, parity has been achieved. That's all now, friends. That's all. With this, I complete my presentation. Only last part I want to highlight. We are on last page now. We are on last page, page number 17, bottom portion. Okay, page number 17, bottom portion. I have tried to summarize. See, as far as amendment made by Finance Act 21 were concerned, they were applicable from assessment year 22-23 across the board. So the year that has gone by, for that day, these amendments are applicable. But as far as amendment made by the Finance Act applicable, they are applicable for 3 different assessment years. And I have told you, so here I have tried to summarize for the purpose of recap or for easy reference. What is liable for, what is applicable for assessment year 21-22? Option to treat voluntary contribution as corporate donation. That Ram Mandir case, not applicable to most of the trust. Okay, so 1/4/22. So the assessment year 22-23, that is provision for cancellation. This is provision for cancellation of registration or approval. New provision will be applicable from 1/4/22. And secondly, application will be allowed on payment, that is cash basis only. So assessment year 22-23 onwards or 22-23 and onwards, application will be allowed on cash basis only. This is the provision that one has to keep in mind, and all other provisions are applicable with respect to assessment year 23-24. With this, friends, I complete my presentation, and whatever I knew and whatever my study was, I have tried to share with you. Thank you, friends. Here, since we are in virtual mode, I am sitting in my office, or you are sitting at your place, so I can't see your faces, and I am not able to judge whether you have liked my presentation, you have understood, whether you have not understood. I am not aware now, but I have made a sincere attempt of covering whatever has been whatever amendments have been made by last 2 budgets, and try to explain to the best of my ability. Thank you, friends. Thank you very much. I am not able to hear you.
Can you hear me now?
Yeah. Yes.
Okay.
If there are
So
any queries, I can answer. If
yeah,
there are any
definitely,
queries.
definitely,
Yeah.
definitely.
Yeah.
So
Yes.
before we go towards the query, before we take the queries, as you said, you have shared your experience, whatever you had. But I must add into it that the way the decades of experience you have in the taxation of trust and all, I know that you can just your discussions can go on and on, but somewhere we'll have to draw a line and we'll have to conclude as the
Yeah.
time is the constraint.
Yes.
So, sir, very well covered, and you have touched upon all the important changes within the permissible time. So now take the queries whatever members have participants have given in the chat box.
Okay.
1 second, sir.
Can you read out?
So since I was running through your presentations, I couldn't list down the queries in a separate sheet, but now I will read through chat box only,
Okay.
right?
Yeah.
So first query is, sir, would you like to share the presentation with the members and participants? So I think before we go towards the query, the members are more interested in your presentation. So definitely with your permission and approval, definitely we are going to share your presentation with the members.
Yeah. Only one thing. I'll again mail it to you. Only while mentioning date on the top, it is 14/2. I have mentioned erroneously. It
Okay.
is today's date. That is the otherwise there is no change. I'll just to correct that reference to date. To date. I'll mail the new presentation also once
So
we conclude.
thank you, sir.
Yeah. But the same there is verbatim. It is same except for the date. Okay. Yeah.
Okay. So second query, in case of a trust formed by a private limited company for the purpose of the employee's gratuity funded through a LIC, what all are the provisions that are applicable, and income tax exemption is not available? Can we apply now? That kind of query is there.
1025 it is they do not fall in this regime. These trusts are for the employee benefit or the welfare funds are there. You please see section 1025. Their recognition can be granted by the commissioners. Okay, so they don't fall in this category. They are not charitable trust. They are not charitable trust. They are for the welfare of employees. So employees is a particular category only, and it is not a general public. So it falls under section 1025, not here, not under section 11, not under section 1023.
Okay, so they are saying they should be apply for the PAN and file the returns of income for the current year as well as for the past years.
No, say that benefit will be available under section 1025 only.
Okay.
So unless and until that is registered and approved by the commissioner, they will not get benefit of exemption.
Understood.
Yeah.
So second question is the income which is not received, we can file form 9 and request for the deferral of the explanation. Please confirm.
Yes, not 9, it is 9A. Either you can file under first regime, under section 11(1) benefit, it is 9A, and section 11(2) benefit, it is form number 10. So for 5 years. So either for you are carrying it forward for 1 year or you are carrying it forward for 5 years, form number 9A, or you will be filing form number 10. So you have to file before filing return of income. Trust has to file. Trust has to file. Yes. It is old position. It is old position. Only as far as 1023C was there, there was no requirement of filing such form. That provision has been added in 1023C. Earlier it was there. Section 11 it was there, already there, very much there. And we can expect that they will either specify the form number 10 itself with some changes for that purpose. They will specify mostly. That is what I feel. We have to wait for notification or circular.
Right.
Notification. That is good.
Right. So next question is, auditors fees are provided at the year end and paid in the subsequent year. So is it mandatory to exclude the audit fees for revoking 85% limit in the view of mandatory payments on a case basis?
Audit fees was whatever expenses of administration, account writing fees, audit fees, then establishment expenses, all are allowable as application as far as section 11 is concerned. But now the amendment has been made which says that actual expenditure that has been spent, actual amount that has been spent. So as far as income side is concerned, you have to apply accrual principle if at all you are following mercantile basis of accounting. But expenditure side, you cannot follow accrual basis. Only amount spent, provision will not be allowable. When the amount actually spent only will be allowable for the purpose of calculation of 85%, etc.
Okay. So next query, sir, in the form 10 audit report, whether both the income and expenditure
10B,
figures,
10B.
yeah, 10B audit report, whether both the income and expenditure figures has to be reported or only expenditures are to be reported.
I think that there is form number 10A, amount applied to, it says amount applied to charitable purposes. Amount applied to charitable, that confusion is there. Just a moment, just give me a minute.
Yeah.
See here, there is always a confusion, and people keep on asking me this query. This is a first item of this form is there annexure, amount of income of the previous year applied to charitable or religious purposes in India during the year. So here the friend must be having a query. So this is amount of income of the previous year applied to charitable or religious purposes in India. Okay, whatever is income that has been applied for charitable or religious purpose. So the amount of application has to be given. Amount applied, that has to be mentioned.
So application of the
Yes,
that only they
not income, application.
only application.
Yes.
Okay, sir, the income which is less than 2 lakhs in a year, can we file form 9?
No, if the income is below 2,50,000, the income is not taxable. There is no need to file form number 9A. You can file supposing income is reduced to 2 lakh rupees. There also you can file form number 9A, but that is not needed. If the income in case of trust or society is below 2,50,000, as it is not taxable. It is not taxable. If the income is below 2,50,000, it is not taxable. Okay, tax rate of individual is applicable, which with say up to 5 lakh, then up to 10 lakh, etc. So table of individual is applicable. So up to 2,50,000 there is no tax. So income is below 2,50,000, there is no tax. No need to file form number 9.
I think next query is again the same in case of the trust formed by a private limited company, purpose of the employee's gratuity. I think same question is repeated.
I have
we have already covered.
Yeah.
Okay. Sir, what is the due date of trust if we have the surplus more than 2.5 lakhs after applying 15% set-off?
See, you have to see gross income of the trust. You have to see not net income. You have to see net income after giving. See, the provision says the gross income, that is without applying benefit of section 11-12. What is the income? That is receipt side you have to see, income side you have to see, not expenditure side. So if that is more than 2,50,000, the filing of return is necessary, filing of audit report is necessary. Everything has to be done, and that is to be done by due date. If the audit is necessary, filing return is necessary, the due date is 30th September for audit report and 31st October for return.
Okay. So now is the next query is in the schedule, details of both corpus donation and the other income is to be reported, and the expenses figure are also required to be reported in clause 1023C. 1 second. Further is writing exempted trust. So assessment is done by the CPC under section 11 without giving the deduction of expense, and raise the demand what to do.
No, this particular query I'll have to see. Please request the friend. You can share my email ID and I'll see that. It is not advisable to just suggest any way out without looking at the proper facts and figures.
Okay. Next query is a reasonable rent paid to the trustees for the premises used to carry out the activities of the trust, whether the exemptions can be denied by to the trust?
No, no, no. Exemptions will be available. A reasonable rent paid, a reasonable salary paid. There is no objection. There is no. Only thing is tricky part is what is reasonable. What is reasonable? That is a tricky part. So the trust should have a like say some documentation or some information like say rent for that particular premises is 20,000 in the area and the trust is paying say 13,000, 14,000. It will be treated as reasonable. It is not paid at commercial rate. Even if it is paid at commercial rate, there could be disputes. So my suggestion is whenever the trust is paying salary or rent or such thing to trustee, then always to have it on lower side. It should not be viewed by the department as you are paying commercial salary as commercial scale, you are paying rent at commercial scale. You have to be somewhere climb down. Some leeway has to be kept there. Okay.
Okay. The
Reasonable
next
rent,
question is what is the
reasonable rent, reasonable remuneration is allowable.
okay. So next question is what is the difference between the form 9 and form 10?
Form 9A should be Form 9A. Form 9A. See, I have explained. This is basically, see, these basic provisions, friends, you should be aware that supposing 85% of the income is not spent. I have explained this. 85 out of 10 lakh rupees, 85% of the income has to be spent to be entitled to benefit. So 15% you can accumulate. So 85% has to be spent anyway. So if the trust is not spending or applying 85%, say spending only 75%, then two options are emerging. That is carry it forward for next year or carry it forward for 5 years. If you are carrying forward for only 1 year, then form number 9A under section 11(1). And if you are carrying it forward for 5 years, that is then 11 subsection 2 option you are choosing, and that is for 5 years and form number is 10. So 1 year form number 9A and 5 years form number 10.
Okay. So next query, the trust has bought a car in the name of trustee. Invoice and RC book, it is on the name of the trustee with his designation as a trustee. And TCS is on the name of the trustees. On individual names, we have disclosed it by way of a note to account, notes to accounts debt, but does not, it amounts to a violation of the payments made to the specified person. Any additional qualification in form 10 be required?
Then if you are disclosing it in notes, that is good enough. But one should advise the trust to get it transferred in the name of trust itself. That is my suggestion earliest. There would be some fees, etc. But then whatever, it is advisable. But holding it in name of trustee is not a proper scenario, not a correct scenario. Putting remark in audit report is qualification, not a qualification. It is a remark in audit report. But supposing the value of if it is of substantial value, then it is problematic. So one should advise trust, not in writing, but say one should advise that trust should get it transferred in his own name. That is better scenario.
Okay, next query, sir. Whether the accumulation provisions for filing forms to be prescribed the applicable trust whose the gross income.
No, just get again. Just come again. But there was some phone call on my phone, so I got distracted. Just please read it again.
Whether the accumulation provisions for filing the forms to be prescribed the applicable trust whose gross income is less than 5 crore under section 1023.
I am not clear about this query. What? For supposing I understand it this way, as far as the trust below 5 crore are concerned, educational institution and a hospital, etc., which are below 5 crore, only they are required to file return of income. They are not required to even get approval, etc. So here the question of filing any form does not arise. The question of filing form will arise only in case of the trusts which are falling under 1023(6) and 6A. Their gross receipts are more than 5 crore. Where their gross receipts are more than, income is more than 5 crore, then only this option, that is statement, if they want to carry it forward for next 5 years, then in that case, such trusts only are required to comply these provisions or filing the statement for the purpose of carry forward. Trusts which are having gross income falling under 1023C, other clauses, sub clauses, they are not liable. They are not required to file such statement.
Okay, sir. Next question: can an educational trust incur expenditure on the religious activities up to 5% of the receipt?
But then now that cancellation provision, that is permissible, but cancellation provision can trigger now. No. Now there is a problem. If your objects, if whatever your objects are, maybe your objects are educational, but you are spending on medical objects, they have created that problem. The department has created this problem. Actually, they should amend this provision and say for other charitable purposes permissible. But as on today, the position how it stands, that whatever your objects which are mentioned in your trust deed or your memorandum, but the trust should go by that and religiously spend on such objects only. That is my understanding, or I would give a advice like this.
Okay, sir. Next question: can a trust prepare a financial statements on a cash basis?
Yes, we generally advise trusts which are not companies, that is we have a general trust, we always advise them to maintain account on cash basis. It is most advisable scenario.
Regarding new provisions to come to upload the donation list. So it has already come, and I think they're expecting.
Yeah, it is
comments from
already
you.
come. You must have done for the trust, must have filed them, na? 10B forms. See, form number 10BD was required to be filed by 31st of May. After the end of the year, that form number 10BD is required to be filed. Okay, giving details of all the donations, various type of donation, that is corporate donation, specified grant, etc., other donation, whether received in cash, whether received in kind, etc. With all this breakup, with the name of the donor, with PAN number and all that, this was required to be filed, and this is a now continuing feature. So every year after the end of the year, form number 10BD is required to be filed by trust which are registered under or approved under section 80G. Those who want to claim benefit or those who want to confer benefit of 80G to their donor, then those trusts registered approved under 80G5 will have to file form number 10BD every year after 31st March up to 31st May.
Okay. Next question, sir. Trust has invested in fixed deposit of a listed NBFC, whether approved under section 11(5) or if
No,
no, whether the
you
qualification
you have
required.
to find out. One has to find out from that organ. According to me, it may not be a approved investment. According to me, it may not be an approved investment.
Okay, I think ATG. There's some one member asking for ATG benefits to the donor. What are the benefits to the donor who are donating under ATG?
Arey bapre. That
Sir,
one should study ATG. No, one should please.
yes,
I would
yes.
advise that friend that he should read ATG for the. It's a lengthy section. One can give
Right,
lecture for 1.5 hours on ATG as well.
right,
Okay.
right.
Yeah.
So next question, sir. 10BD requires PAN. So donor without PAN are missed out and can't be reconciled with the total donation.
No. Problem was what they have done is they have for code they have given that PAN is there, then Aadhaar number is there, then I think driving license etc. is there, voters ID card is there, passport is there, various things are there. Either of it should be there. No, ration card is also there. I think so. So something has to be there. No, if nothing is there, even then what I feel is as far as the return I have seen, it does not have any reference to 10B. It is going in old fashioned manner, that is PAN of donor, PAN of donee, etc. So 10B reference is not found. Anyway, you have donated and 10BD form has been generated, 10B is available. Supposing 10B is issued, then benefit can be claimed. But I think these options are available. All the options are available. Either of the options should have been utilized.
Yes. Sir, whether it is mandatory for the trust to report all the donations in form 10BD?
Oh, it is necessary, but supposing you are like say now supposing some PANs are not available, and in fact when we were trying to upload this form number 10BD, forms were there, PAN number were there of trustees, Aadhaar card were there with available with our trustees. In spite of that, the system was throwing error, so we had to file with other options, And but then this could happen. This could happen. So in that case, whatever is the best possible option, one should follow. Whatever is the best possible option. Say only thing is once it is details are uploaded in form number 10BD and form number 10BE, that is certificate is generated from the site. That is a good enough. That is good enough for the purpose of claiming deduction. That is my understanding.
Okay, so next similar question is, sir, if in case of in form 10BD some donations are missed out, so whether any penalty is leviable on it?
Yeah. Supposing has this I have left unanswered your previous question to this extent. Say supposing 90% of the information was available at the time of filing first statement. You can file, the trust can file a correction statement. That option is available multiple times. Form number 10BD can be filed or correction statement can be filed for the things which are left out, or for correcting any, supposing some details with respect to amount, or some classification of donation was not proper. Corpus has been given but mentioned as specific grant or something like that. Say for any mistake that has occurred while filing first statement, or anything which is left out can be corrected, can be filed by way of either additional statement, or can be by way of correction statement. Multiple forms can be filed. And penalty is there. Penalty and late fee, etc. is there. But supposing you have filed, actually this being first year, they may not come out go down strictly with this aspect. There may not be penalty or late fee, but one cannot be very sure of the department. So one should always file a correction statement if anything is missed out, or
Okay.
or additional statement or correction statement.
Okay, but probably this would be the last query. What
Yeah.
happen if one continues to keep the amount in the bank account instead of depositing in the fixed deposit?
No, as far as 15% accumulation up to 15% is there, generally there is no condition of investment in specified mode. Investment in specified mode is a condition prevalent, or condition for the purpose when you are carrying it forward for 5 years. That amount has to be kept invested. Okay, then amount has to be kept invested. Here there are two options. That amount has to be kept invested, need not be in what say we can say in FDs. Only as far as corpus donation are concerned, where the donation is corpus donation, that amount has to be kept invested in FD. But going forward, as far as 11.2 is concerned, going to the finer point also, it is most advisable scenario to invest in FDs subsequently. Okay, as far as corpus donation are concerned, investment in FDs are there. They are to be made before end of the year. As far as 11.2 is concerned, investment in FD can be made after the end of the year. But as far as up to 15% accumulation is there, that can be kept in a regular account also. And even when you are specifying the option under section 9A, that is accumulation only for 1 year, there also amount can be kept in regular account.
Okay. Sir, two more queries. If a donor directly deposit the donation about 2,000, can a donor claim the deduction under 80G? It is not. They have directly deposited. I think through maybe online banking kind of thing.
Possible, no? There is no problem. There is no problem.
Okay, trust invested in FD in violation during previous year, can be qualified in current year?
Violated,
It
not
was
invested in FD.
the FD was not with the proper scheduled bank or kind of things. So there was certain violation in previous year. So he's asking whether we can qualify in current year.
Only thing what comes to my mind as far as the corpus donation is concerned, then supposing I have given example, supposing out of 10 lakh, 8 lakh are invested and 2 lakh are not invested, then first year it becomes taxable. Then second year, supposing this amount is again invested, that provision says that when the investment is made, that will be entitled to benefit. How it happens, how they allow in the return and all that we have to see. But then as far as provision is concerned, that should be allowable as far as corpus donation is concerned.
Okay, and now members are asking for the email IDs. So
Email ID you can share, but then supposing I see this is a return filing time is going on up to 31st. So they have to be little patient if I don't reply immediately, but I'll definitely reply. If a short query is there, I'll reply in 1 or 2 days time. Okay, you can share my email ID. No problem.
definitely. We respect your time, sir, and in spite of your busy schedule and looking at our chat box flooded with the queries, and hopeful, and you definitely were satisfied all the queries and you replied each and every query to the extent possible. So really appreciate your efforts and we have put in for this presentation, sir. So now let me take this up. Yeah, so now let me only take this opportunity to propose a hearty vote of thanks on behalf of our JB Nagar CP Study Circle. Sir, on behalf of our JB Nagar CP Study Circle and on behalf of all the participants, we propose, or I propose, a hearty deserve well vote of thanks to you, our today's eminent speaker, CS Suhash Malankar, sir. Considering his decades of experience in the taxation of trust matter, his presentation was full of information, full of amendments. And thank you very much, sir, for sparing your valuable time from your busy schedule. So we thank you very much, you sir, for your time. And we thank all the participants for joining us on Sunday morning in spite of their busy schedules on a very important topics. So we thanks all the participants and coordinators for having today's session. Thank you very much, sir.
Thank you. Thank you.
Thank you, everyone. Thank you. So we are concluding today's sessions with all your permission. Thank you.